Selling puts is one of the easiest ways to make a ton of money in the stock market. So if you guys don't know how to sell puts and generate revenue, stick around for the video and I'll explain how to use it. So would you guys like to make 10, 20, $30,000 or more a month just selling puts? Well, to be perfectly honest, so would I. And I've seen way too many videos on YouTube about how this is essentially free money. And I'm here to tell you it isn't. And there's a lot more to it than some of the people talk about. So stick around, I'll get into it. Hopefully you find some value here. I'm also going to explain about selling puts because it's not a bad strategy. I just don't want people misled about when I see some of the other videos that I've been seeing. So, those of you who don't know me, my name is Adam Kahn, and I'm the Rational Investor. Thanks for tuning in again. I hope your day is going well. Today is Friday, January 12th. I'll also get into a little bit of a market wrap up as well. We'll talk about CPI and PPI and how the markets did. It was an exciting week for the markets, although they just kind of bounced around and didn't go a whole lot of anywhere. Even though they went up, they went down. Nothing too exciting in the end. So let's talk about put selling to begin with. If you don't understand the concept behind this of doing a cash covered put sell, essentially take stock X, and I'll make one up, and we'll call it around $100 just for ease. You can choose to sell an option, a put option, on that stock. And what that is essentially a bet as to the stock going lower. So let's say you sell a 1 month out $95 put. When you write that option, somebody is going to pay you money for that option. Depending on the volatility of the stock, essentially depends how much you get paid. So ease of ease of explanation, let's say they give you $1 for that 95 put a month out. If stock X is below $95 at the day of expiration, as the seller of that option, you have committed to buying 100 shares of that stock. Now, you get to keep the $100 no matter where the stock goes. And this is what a lot of the people focus on who talk about the put selling. Like it's this free $100. Well, you're getting paid for the risk you're taking because if the stock goes below 95, well, you're responsible to buy it at 95 no matter where the stock is. So even if it's trading at $85, you're still paying $95. You got that dollar, so you could even think of it as if you're paying 94, but when it's at 85, you're down $10 from the strike price. You're down $9 total in terms of the purchase, so you're down $900 at this point. Maybe it's a stock you wanted to own, maybe you were perfectly happy buying at 95, but it is not free money. The nice thing is if the stock goes higher or closes above 95, you still get to keep the $100 either way. So they are correct in that aspect that when you write the put and you get that dollar, or since it's for 100 shares, $100, that is your money to keep. What they kind of leave out is the risk of the market and that things don't always go so perfectly. You know, a lot of them talk about how easy it is to just turn around and sell calls. Well, I did this with Coinbase. I don't know if you guys saw my video the other day. I sold a 142 put that was expiring today. Well, Coinbase closed around 131. I did get almost $3 for that put. So I'm kind of long from 139, but it's at 131. Well, from there, I make a decision, and sure, I already sold next week's 143 call against it to try to make $1 on the stock, as well as the extra money from the options that I sold. But there's still risk to that. I am down money on the trade. And every time I watch some of the people, I don't want to accuse everyone, but one popped up on my feed that she really simplifies it a little too much and doesn't really prepare people that there's good and bad. And maybe she's just super lucky that every stock she picks always goes up. But I know they talked about Tesla, and Tesla's had a rough few weeks. So it's hard to imagine that all of them has worked out. so perfectly, like explained. Now, it's a great way to get into positions that you want to purchase. If you want to own a company and you like the idea of collecting some revenue while you wait for it to get to that price, if it never gets there, at least you get something. And if you're willing to buy the stock anyway, you're getting paid to buy it where you want to buy it. So we'll use stock X again. If you want to buy it around $90 a share and it's at 100 and you can sell a month out put for 50 cents and get $50, there's nothing wrong with that. Just be prepared that if it's down at $80 at expiration, you're still buying it at 90. If you were going to buy it at 90 anyway, no reason not to get paid. Like, I totally get it. And if you want to use other option strategies like the swing trading and selling the calls against it, these are all good ways to try to make money in trade. Just keep in mind, a lot of the people out there don't explain it well. I don't think they really understand what's involved and what the options are. I reached out to one of them and I said something because they said that delta is the percent chance that it ends up being a winning or losing trade. That's sort of correct, but it's also kind of naive and it's really simplistic. I mean, delta is the percentage that the option is going to move in relationship to the stock. Yeah, if it's a 16 delta, there's a 16% chance at that moment probably that it ends up out of the money or moves against you. But again, you really should have a better understanding of the underlying stuff in an option. You also have time decay and you have the volatility and you have gamma. These are all aspects of options that are important to understand. Now, not if you're just using it to get into a position that you want to get in anyway. Really, I don't see anything wrong with that, and I think it's a great strategy to get a little bit extra money. Like, if I'm going to put a $90 bid on stock X and just wait for it to get there anyway, because I want to buy it in my portfolio, I don't want to buy it where it is today because I think it'll get better, I might as well get paid a little bit to wait for that. I think that's a great thing to do. Now, you guys have to do your own research. This is not financial advice. Reach out to a financial planner and ask them questions as well. You need to make your own decisions. I'm just sharing what works for me, so please don't use it as financial advice for you. A put is a great way to protect yourself from the downside, and it's kind of like having insurance about against a market collapse, which is why I like the idea of selling them. That again, I don't want to say it's not a good strategy. I just see people touting it as this like free money that's so simple to do, and really it isn't that simple. Now, a good way to use calls that I did in another video is I sell out much later dated calls. One of the examples I used is I bought Google recently. I bought around 140-ish. It's trading there right now. Well, I sold next January's $210 call. Well, I'm okay with that. I got $2. So it's kind of like a dividend, just like the put. You get to keep that money. So I got 200 and I think it was like $210. But I get $210 to own a stock that I own anyway. I'm not going to sell it either way. But if it gets above 210, I am committing to selling 100 shares. Well, if I make $70 on the stock in a year, that's really good return. I'll be okay selling 100 shares of Google. Remember, Google's one of those companies that I own in the safe deposit box as well. So I'm not doing that with shares that I want to own forever. There's a handful of companies that I want to own as much as possible, and I want to own them forever. Amazon, Google, Facebook, or Meta, it's also known as. These are like core that I want to own forever. I have AbbVie in there as well if you guys are curious. I'm happy to go through the list. If you want me to tell you all of them, let me know. I'll do another video on the stocks that are just sitting in the safe deposit box. So again, don't be scared to use the put selling strategy, but don't be fooled that this is some way to make 10 grand, 20 grand, 30 grand a month easily. If you're trying to get that type of return, you're a trader, and maybe you're really good at it, maybe not. I'm not saying one or the other. Just be really cautious about the people you're listening to and the information they're sharing. So, again, if I didn't say it in the beginning, I think I did. Do me a favor, hit that subscribe button. Oh, I don't think I did. Hit the like button, make some comments. I really appreciate it. It helps YouTube's algorithm, it helps people find me. So, thanks again. I hope you enjoy your Friday. I'm sure I'll talk to you this weekend. Sunday, I'll do an update on the portfolio again. We'll see what I talk about tomorrow. Bye bye. Before I say bye bye, I know I had said I'd talk about the market and the moves this week. So CPI and PPI came out this week, which are essentially what the Fed watches and what they keep an eye on in terms of inflation. CPI came out a little bit hotter than expected, the consumer price index, which was what caused the market to fall a good bit on Thursday. And then today, the PPI came out, and it came out better than expected or lower than expected. What I find interesting about that is I do think it shows a slowing down of the economy, despite that they look at the CPI, which is the consumer price index, and it came in hot. My theory on this is if the producer pricing index went down, they're doing better. It's getting less expensive on that end. That gives them more room. If the consumer price index wasn't going down, that just means they're busy enough to keep the margins where they are for now. But in time, I think they'll balance out. If the buyers, if the producers are getting their products for less money, eventually that's going to flow through to the consumers as well. And at least what I've seen here in Las Vegas, I mean, rents have come down significantly. I know across the country there are different pockets where it's higher and things like that, but that's all part of the consumer pricing index. So I think you're going to see the lower PPI eventually play through into the CPI. I just think it's a matter of time. What I found really interesting about when the CPI came out, the 10-year bond shot up in yield to like over 4.05, which is what I would have expected. I actually would have expected to have some follow through and maybe even settle around 4.2, 4.25, because the Fed's been talking about 3 rate cuts for this year. Well, 3 rate cuts from the high of around 5% puts you at 4.25. Well, after it bounced up to 4.05, the next thing you knew, it came right back down and it was below 4 again. Then today, with the producer price index, it kind of even secured being below 4. The markets are predicting 6 cuts for this year. The Fed said 3. My guess is, based on how the 10-year is acting, we're probably going to give out 4 or 5 and balance somewhere in the middle. Now, that's just a guess, but I was really surprised to see the bonds react the way they did. I also thought we'd have a bit of a bounce in the stock market that we didn't seem to get today. I think that long term that the stock market's going to be strong and it's going to do better throughout the year. But I think short term it can continue to have some weakness. But I guess we'll see and we'll play it by ear. Anyway, again, I'll repeat it. Do me a favor, give a thumbs up, like, subscribe, make some comments, and don't forget, this is not financial advice. I'm just sharing information for me. I'm just a guy on YouTube. You really shouldn't listen to me other than finding it entertaining, and hopefully you find some value in it. Again, have a great weekend, and I'll talk to you guys again.